All right, guys, welcome to the Buff Show. Today we have a very special episode. Today we have Cade and Michaela Kerrigan on, and they're going to go over assumable loans. This is a very good topic that relates well in today's market with how high interest rates are. There's actually some loans that buyers can assume from the seller. So say a seller they bought their house 2 years ago and they got like a 3% interest rate or something like that. If their loan says it can be assumed, another buyer can step in and assume that loan at 3%, keeping their payments super low. So this is a good one. Listen up. Lots of good tips and tricks here, and enjoy.
Okay, guys, welcome to the Buff Show. I'm Michaela. This is Cade.
Hi.
We Instagram spoke, so we're here talking about assumable loans and interest rates today. So we'll just kind of jump right in.
Yeah. So the biggest reason I think why a lot of people are, interested in hearing about assumable loans and interest rates is because a lot of first-time home buyers specifically are being priced out of the market. We actually have some stats here where if you jump back to 2021, the interest rates had dropped to an all-time low of roughly about 2.65% for a 30-year fixed rate mortgage. And so home prices shot up. Everybody was jumping into the market as quick as they could to kind of take advantage of that super low rate. Now you jump forward to 2023 and you got higher prices due to the increased volume of sales back in 2020, 2021. And then the interest rate jumped from, a 3-4% to a 6-7% in 6 months. Mm-hmm. And the prices of the homes weren't able to kind of slow down as fast as the interest rates were jumping up. So now we've seen this last 6 months, 2022, the market really slowing down. Housing prices are coming down, which is a good thing. But most first-time home buyers and even some others are priced out of the market. They're unable to get into a property that they feel is worth the value that they have to pay every month to get in there.
Interest rates are still at like a 6.25.
Yeah, we
6.25.
just got an email, and for an FHA this week, they were roughly for a 30-year FHA was a 5.875, and then for a 30-year conventional was a 6.5. So rates are changing every week, up and down. Hopefully throughout the rest of this 2023, they start to make their way back down a little bit to more normal numbers. And with the price corrections on homes coming in, I think the market could speed up a little bit again. So, but anyways, back to assuming loans and why we're talking about those. What is the benefits of assuming a mortgage loan? Why would a buyer even entertain the idea instead of just kind of going the conventional normal way of a buyer coming in, getting their own loan, their own new rate, their own new terms on a property and purchasing the property that way? So I'll kind of have Michaela here. We're going to kind of play a little bit of a scenario, maybe a typical seller-buyer scenario, and why a seller might want to at least have the knowledge of their loan being assumable, and why a buyer might want to search out assumable loan and take advantage of that. So I'll kind of have Michaela take the lead on that one.
Yeah, so first and foremost, assuming a mortgage is going to be when you take over the rate, you take over the monthly payment, you take over everything that was that loan from the seller. So from a buyer's standpoint, well, actually, let's back up. I'm going to do a seller's standpoint. Right now, prices haven't evened out with the rates. Homes are sitting on the market for a little bit longer. But as a seller, if you can look and see if you have that clause in your loan, then post it on your first picture. Say 2.5% assumable interest rate, and they are just going like that.
We actually came across two examples with past clients where Michaela, for one, was working with some clients for, it's probably been a couple months now, hadn't it? And then I had a client who was interested in the market, just the rates were kind of pushing them out. And there was two properties that came up. They had been listed for 30 plus days, both properties, not a whole lot of action on them yet. And then I'm guessing that the listing agent or the lender or the homeowner figured out that their loan was assumable and that they had a 2.4 or a 3% interest rate. It was 2.8. Anyways, a low interest rate, below 3, and then a 3% interest rate. And they actually updated their listing and changed the first photo of that listing to an assumable X amount interest rate. Me and Michaela both saw those, knew we had clients, and jumped on them. Immediately calling our clients, sending that listing to our clients, and both clients were like, let's jump on it. Let's see what we can do. And it was that same day that listing had been updated, and we had called on that property, and that property was already under contract. So this is, like she was telling you, this is a huge advantage for sellers. If they can know that their property has an assumable loan, that a lot of home buyers right now are looking for ways to get into the market, and the interest rate is what's killing them. And so if you can find a way to pass off a lower interest rate, the amount of buyers that are going to be interested in your property are going to grow dramatically.
And not to mention, like a side note, the payment for that buyer is going to be a lot less.
Lots lower.
So you can maybe get a higher purchase price on the home if they're able to assume that low rate.
Absolutely. Absolutely. Now, just real quick on the buyer's side of things, why would a buyer want to search out an assumable mortgage? Kind of like we talked about, jumping in and getting that lower interest rate is probably the main and number one reason. It allows you to have a higher purchase price, which then in return gives you more properties to look at. The more you can expand the number of properties you can look at, the better chance, one, you're going to find the property that you like. Two, I know this isn't a super competitive market right this moment, but give you a better chance of getting an offer accepted. And not only that, but giving you, maybe just getting you quite into that price range where your dream home or the home you've been wanting for years or that upgraded property or whatever it is priced at. Also, there's a couple other benefits to looking into these assumable mortgages. If you are able to get into one and qualify for an assumable mortgage, you don't necessarily have to do an appraisal on the property. Now, all of this is kind of subject to your lender, the lender that has the loan. Everybody might be a little bit different. A lot of lenders have different hoops they have to go through, clauses that they have to follow, stipulations and stuff like that. But typically, you don't have to get an appraisal on the property. And a lot of times, your closing costs on an assumable mortgage are capped. So your closing costs are less than as if you were to go and just buy a home traditionally. So those are a couple things that I think we need to look forward, especially as agents on our end. I think we need to kind of be taking our clients and shopping for those specific mortgages and kind of going a little bit of above and beyond to make calls and figure out which loans are assumable.
Yeah, for sure.
So next, we'll talk about how is it done there. So how are our mortgage loans assumable? So let's just take a little bit of a scenario. Michaela's my agent. I'm asking her, I'm telling her I'm priced out of the market, that I can't afford homes that I'm wanting. Everything that's in my price range right now is costing too much. My monthly payment's too high. And so she would take me and she would hopefully find me a new option and find me a loan or a property that has a loan on the property that is assumable. And from there, I have two options. One, I actually don't necessarily need to go through a bank, and that is a simple assumption. And I'll have Michaela kind of tell you about those.
A simple assumption is one form of creative financing that's almost kind of like a seller finance. It's a more common word for it. You don't have to go through the lender. Basically, there's a middle party that helps make sure that the loan is being paid, but basically you're paying that for the seller. So if a buyer isn't paying on time, that can affect the seller's credit score. It doesn't release the seller at all from that loan.
Correct. And I think that's one of the scarier things about simple assumption is that the seller is no longer released from liability. And so if the buyer of the property, and this all kind of comes down to contracts and having the right contracts in place and having good agents and good knowledge of real estate in general to protect yourself. But if let's say the buyer comes in and you do a simple assumption and you give them a 4% interest rate, whatever, and they don't pay that loan, they don't pay you their monthly payments, that liability falls back mainly on you as the seller because the bank has not released you from liability of that loan. Also, there is potential, you got to double check your loan and your contracts, but there is potential that your current loan could be assumable, but if you go the simple assumption route and kind of bypass the bank, they can actually require payment in full due like now, basically. And so that would also be a thing you definitely want to look at in your loan contract.
And that would be from the seller per se.
Correct.
That would be who would be liable there.
So there's one other way, it's novation. And that's kind of your standard way of going through the bank, basically bringing a buyer to the bank, having them assume your loan, and the bank would qualify the buyer for whatever type of loan that you have, and they would have to qualify for that loan. And then if they are qualified by the bank, the bank would then release you from all liability of that loan on that property. So that would be for sure the safest way to go as far as on the seller's side of things and the buyer's side of things too. It's safer, you're protected, and that way it's kind of more of like a regular transaction process, but you're able to hopefully keep those same low interest rates, help lower your monthly payments, and go from there.
And this might be kind of jumping the gun a little bit, but I'm sure people are thinking in their heads, like, someone's going to have equity on this property. If I'm taking over their loan, what do I do about the excess amount? So it's definitely a good question to ask. You're gonna have to come in with cash or do an extra loan or a HELOC. There's definitely options there. But if someone owes $250 on the property, it's selling for $300, you're still going to be required to pay that extra $50, obviously. We just have to figure out where that comes from, and that's going to be talking to a lender, asking an agent ideas on that. So
Yeah, so with her example that she gave, so if the current owner owes $250,000 on a property that he's trying to sell for $300,000, and you come in and assume that loan, you would assume the loan, the term, and all the terms and the rate of that loan for $250,000. Now, you still owe $50,000. You would have to be able to make up that $50,000 like Michaela was talking about with either cash, a loan, a new loan with the current market rate, or possibly a HELOC if you're able to put 20% down on the original loan. So with that, we'll kind of jump forward here with what loans are assumable. There are a couple of them.
these loans that are typically assumable are going to be your government issued loans, your FHA, VA, USDA, some conventional loans, but you're going to want to look for that assumption clause in there to see. But most commonly, it's going to be FHA and VA.
Yeah, so your FHA loans are your most common ones, which is ideal for first-time home buyers. Luckily, that's kind of the market you're kind of pushing for with these, I think. A lot of your first-time home buyers are the ones that are going to be priced out. Luckily, most FHA loans are assumable, meaning that as long as the buyer can come in and qualify for the current FHA loan, so that's typically 3.5% down, a credit score of 620, and income that they have qualifies them for that dollar amount.
And it's your first home purchase.
And it's your first home purchase. As long as you qualify for that FHA loan itself, then you most likely, each lender's a little different, but you most likely will qualify to assume that FHA loan. And then you jump down to USDA loans. USDA loans are a little bit different. USDA loans aren't super assumable. They're best for inheritance or divorces, stuff like that. But they are assumable, but most of the time when they are assumed by a non-family member, they are assumed with a new rate and new terms. New rate and new terms kind of depend on the lender. Some may keep it low, some may jump it back up to market rates, wherever those are at. And then you have VA loans. And I know a lot of people think, well, I'm not military, I'm not a veteran, so I can't even think about those. And this was something that we learned actually researching all of this and learning and kind of just being in real estate now, is that if you're going to assume a VA loan, you don't necessarily have to be a veteran or in the military. Those loans are assumable. You just have to be qualified by the lender for those loans, and the current loan has to have an assumption clause. So the VA loans might be a super good route to take. I think they're just going to be a little bit slim pickings, but as long as it has that assumption clause and you qualify, all you have to do then is just pay the 0.5% transfer fee, and then obviously all the rest of the closing costs that come with that loan. Whereas VA loans don't typically require down payments and stuff like that. So
It's definitely a good way to look into it to get that interest rate a little bit lower.
why is having an agent that's knowledgeable of all these things important for the buyer?
It broadens your options. If you're priced out of the market, you're renting and paying 100% interest. So if you can find an agent that's going to really kind of dig deep and do that work for you, find the interest rate that's going to work best for you, it opens up options for a lot of people, I think.
Yeah. Actually, we had another agent in the office today. Actually, I was just talking to him about real estate, and he actually mentioned that he had a client that said that he didn't want to jump into the market yet until the market had dropped 20%. And a lot of this is just kind of, I think, is a little bit of naiveness about the market, thinking that you can time the market, thinking that you know the market better than 100,000 million other people, when that's just not the case. Nobody can really time the market perfectly. Nobody really 100% knows what the market is going to do. And even if you look back in 2007, 2008, when we had the big recession, the national average of the real estate market drop was only 17%. And not saying that we won't drop 20%, not saying that that's kind of a really, not very smart idea of this client, but being able to have an agent help you find a different way into the market, I think is more beneficial. One that can say, look, the conventional route's not going to work right this moment. Interest rates are too high. The homes that you guys are liking or wanting to get in or think that it's worth are priced too high with the current interest rate. But if we can really dig deep, make some phone calls and search out those types of loans, specifically FHA loans, VA loans, and then I know some conventional loans that have the adjustable rate mortgage on them, and then as long as the buyer doesn't have any, they won't refinance into a fixed rate loan. Some conventional loans can be assumable as well. So as long as you can get an agent or somebody that's willing to dig deep and find those specific types of properties, you might be able to open up what it is you can buy. And you might not have to wait for the market to drop, because when the market drops, interest rates are going to come back down. You may already be into a property, gaining equity on that property currently. And then when the market drops and heats up, you're just in there already and gaining more equity in the property. And then if interest rates drop lower than what you got, refinance it, get a new rate.
Yeah, for sure. I think an important thing to say too, since we brought 2008 into it, is the market didn't drop for very long.
No.
Like, it recovered fairly quickly. And so even if you are getting in now, if you can afford the payment, even if the market drops, it's going to recover. You're not going to be stuck for long. So
Absolutely. So I want to talk about a couple cons for assuming a mortgage loan really quick. One of the biggest ones, I think, is that you're limited to the lender that has that loan. So if I wanted to buy Michaela's property and I wanted to assume her loan, but I have my best friend lender, Bob, over here, who I really want to use, I can't use Bob. I have to use whoever Michaela used and go through that lender to purchase that property. So that could be a potential downfall. The other one is that if you take the simple assumption route, you put yourself at a little bit more risk as the seller, specifically, that you are liable if that buyer faults on the contract, breaches the contract, fails to pay their monthly payments. That can directly affect your your credit score, and 2, you could be held liable for those monthly payments that aren't being paid.
On the opposite end, as a buyer, if you do a simple assumption, it usually requires a larger down payment because you're not going through the bank to get those loans. So you'll have to bring that money in cash.
Absolutely. Okay, we did pull up a quick example.
Bear with us because it's a lot of numbers, but I think it'll put in perspective a little bit how this can be beneficial for a buyer side.
Absolutely.
So we pulled just kind of an idea. So a $500,000 property back in 2021 when interest rates were at an all-time low. We said they had a 3% interest rate, 3.5% down payment for an FHA loan. The loan amount came out to $482,000, and the monthly payment was $2,034. So if we took the average appreciation, which was 5.2% between January 2021 and January 2023, then that same home would actually be worth $526,000. So the seller paid down their mortgage down to $462,000. So the gap there is $64,000 that you would have to come up with if you were to assume their current mortgage. So you assume the mortgage, you have a monthly payment of $2,034, get a separate loan for the $64,000, and we said, so right now rates are at a 5.875% for an FHA loan for a 30-year mortgage. Over a 30-year span, that would come to $380 a month, sorry. So total, you're looking at $2,414 a month for a $526,000 property. So Cade came up with the numbers for if we were to just do an FHA straight across with a 5.875%.
Yeah, so if you were to purchase that same property, and we're assuming that we're purchasing both of these properties as on the value of the property. Let's say the appraiser comes in, appraises the property, and it grows 5.2%, and it's priced at now $526, and that's just what you're purchasing the property at. So if you were to come in with a conventional loan, purchase the property at $526,000 with a 5.875% interest rate, you would put the same 3.5% down, which comes out to be $18,410. Now, with those numbers, including property taxes, your interest, your monthly payment for that property is now $3,002. So there's approximately $600 a month difference there. And so that's how assuming a mortgage with a lower rate can really dramatically increase your buying power as a buyer, or how it can really draw a lot of attention to your property as a seller really quickly. You immediately gain tons and tons of potential buyers to that property, people who can actually afford that property now. You know, $600 a month, that's a big difference, and that would include a large pool of people who can now afford that property, which now makes your property desirable.
Definitely
Very
does.
desirable. So
Definitely keep in mind these are like very general numbers, very situational. So if you have further questions about the financing of anything, I would get with a trusted lender or even a trusted agent and sit down with a lender and an agent and talk over options and anything else there that could happen. But
absolutely. We took a poll on Instagram, and that's kind of how we came up with this topic. Was we put a poll out there and we asked what people wanted to hear about. We did HELOCs, we did our current property that we have that we purchased for eventually it's going to be a rental. We're in the remodeling process right now. But then our lease options and then mortgage assumptions. And this one is what came out to be what people wanted to hear about. And if there's something else you guys want to hear about, if it's one of the other 3 options, or if there's something new you guys want to hear about, feel free to reach out, shoot us a message, and see what we can do.
yeah, definitely. Thanks, guys.
Thank you.